Live on Facebook for the Tuesday edition of the Not Your Average Investor Show. Today, I am your host, Pablo Gonzalez. With me, as always, the man they call GC because he is your guidance counselor for real estate investing and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Good to be with you.
And today, it's been a while since we have a guest, Gregg, but today we got a guest for the ages. We have a man who is the director of the Fortune Builders Passive Income Club. Through Fortune Builders, he's helped thousands of real estate investors build the right mix of passive investing into their portfolio, has been involved in over $500 million worth of real estate transactions, and is the key decision maker, the gatekeeper when it comes to referring Fortune Builders clients to turnkey providers. And he happens to be a JWB client himself. He is kind of like the Jason Statham of real estate investing because of his haircut and his good looks. And his name is Paul Shively. Welcome, Paul.
It's good to be here. Anytime I can have my first cup of coffee and get compared to Jason Statham, that's a good day. Today's gonna be a good day. I'm happy.
Am I the only one? Who's Jason Statham?
Don't worry about it. Don't let the details be in a good story.
Okay. All right. We'll roll with that.
I'm glad we had that interaction just now. Anybody that's joining us today, welcome. We have over 47 attendees already on the call. We love our community here at the Not Your Average Investor Show. I see John Hanning already in the chat. I see Sue in the chat already. I see Zach Correa. Aloha, Zach. Good to see you, buddy. And you guys know, you ladies know that this is an interactive show. We want you to be a part of this. You're a part of this family. Anybody that's new here, there's two ways to interact with us. Number one is that chat button on the bottom left where we already see people interacting with. And there's a little trick to that. It is set as a default to only speak to Gregg, Paul, and I because it says panelists in that blue box above where you type. If you can do us a favor and drop down that blue box and put panelists and attendees, now everybody can see what you're saying. You can make a new friend. You can get some great advice. There is a bunch of really sophisticated real estate investors here with us right now. So you don't want to miss out on the group knowledge that happens in this chat. Number two, if you want a question asked to any of the guidance counselors that we have here about real estate investing, the best place to do it is to pop open that Q&A box that's on the right on the bottom and put the question in there because you're going to see that the chat moves really quickly. My talent is limited, so I will go cross-eyed if there's too many questions in too many places. We also have people joining us on Facebook Live, which welcome Facebook Live as well. And let's kick it off from here. Also, if this is your first time coming, you want a breakdown on rental income property investing, and you want to spend 20 quality minutes with Gregg telling you the three things that you really got to knock out of the park in order to get into this asset class, go to jwbwebclass.com. You're also going to get a free investor toolkit, super, super valuable use of your time. And if at the end of this call, you just want some really personalized advice, you want somebody to build your plan for you, go to chatwithjwb.com, pick out a time, talk with the mics. It's going to be another really good ROI on time for you. But without further ado, it's the star of the show. The Jason Statham, Gregg, is the star of the movies Crank. He made his debut on Guy Ritchie movies, Lock, Stock, and Snatch. Now he's like a super big action star that's in the Fast and Furious franchise. I'm surprised you don't know, buddy. What's going on out here? Do you know
I've just been locked into just cash flow positive investment properties for the last 20 years of my life. So haven't come out of that shell there to go and find out what's going on in the cultural world there.
Well, we're not going to be changing this show to the Not Your Average Pop Culture Show anytime soon, but that's fine. Paul, welcome to the show, my friend. Can you give, for those of us that have been under a rock in the real estate investing world, can you just give us kind of a little background on who you are and your experience, my friend?
Yeah, for sure. Happy to be here. Super happy to be here. Gregg, I'm like you, man. Like I have my team. So my team is I've got a good mix of younger people on my team and some gray hair on my team, which I love for the experience. But the younger people, they always razz me and tease me because I come around the office and I'm like, hey, what is this again? And who is that? And can you help me understand what does this song mean? I feel like I'm an old man already.
And honestly, hanging out with you, Shively, like you're the old man of the bunch between you and me. Yeah. But now cool. I feel a lot older and out of touch than you. So way to go, Pablo. You were able to break that.
It's karma. What goes around comes around, my friend. No, for those of you who may not know me, super happy to be here. My name is Paul Shively. I have the absolute honor to be the director of investments at Fortune Builders, right? So what does that mean? I work with Than, Merrill, Paul Asajian, JD Asajian, Konrad Sokolnikov, who are our founders at Fortune Builders. And Fortune Builders is one of the premier real estate education companies on the investment side in the country. We've got thousands and thousands of students across this great country of ours. And I am very fortunate to run all of our actual real estate investing side. That's not to do with flipping, right? So we do a ton of flipping. We've got anywhere from 20 to 30 flips going on at any given time here in the San Diego. So we're headquartered here in San Diego, and that's JD Asajian. He's the man, myth, the legend on that side of the business, what we would call the active side of the business. What the passive side of the business is anything we're gonna hold long term. That's the business plan. So I oversee that side of the business with Dan, Paul, and Konrad here. And yeah, love it. I say I've got the best job in the world because I get to do real estate, but it's with that education component. So with our community, we get to teach them and educate them and also help them and build them plans to get them on that path to financial freedom as well too, or a little bit further down that path for financial freedom. So I got the best job in the world because I grew up playing sports. So I'm a big team sports guy. I like being a part of something bigger than just me. And I don't think investing is very fulfilling when it's a solo sport personally, right? So I love the team aspect. So being able to help people, being able to get those text messages and those phone calls and those emails, Greg, you've got a laundry list of them too. I save them all because I love them. On those dark days, you go back to them and it's like, hey, thanks, I just dropped my kid off at college, or hey, thanks, I'm able to retire my spouse or whatever it is, or hey, I got a picture. I got one investor who keeps sending me pictures of beers from all over the world, right? Because he goes and he just travels now because of his portfolio. And that's a cool text message to get. Hey, my daughter's college education paid for now, thanks to you guys. Thank you, right? Like that's the cool part of my job. So I love real estate, but I love people. And so what I get to do kind of melts both of those. And it's been a great decade. Been a great decade. So you got to rein me in, Pablo. I'll go forever. So sorry. That's a little bit about me and who I am, and I'm super happy to be here and hang out with an old friend and a new friend. So I'm excited.
Awesome, man. Awesome. All right, listen, you can get me. I'm not going to rein you in at all if you want to start talking real estate and people and great stories of impact, man. But you yourself are a real estate investor, right? Can you kind of tell us how you got started in real estate?
Absolutely, yeah. So I've been investing for about 10 years now. My story is depends on how long you have, right? But it actually, believe it or not, so I played a little bit of baseball, professional baseball, had a little bit of money coming out of school and had no idea what to do with it. And thankfully I met Than, the Merrill, on the beach playing volleyball, believe it or not. Actually, beach volleyball led me to this. So I'm very grateful for beach volleyball always. The learning lesson from this is go play beach volleyball. That's the
you have no idea, Paul. Greg and I met playing beach volleyball as well.
There you go. Beach volleyball is the key to every success. That's funny. And yeah, so I didn't know who he was, right? I had no idea who Than Merrill was. I had no clue. And I was playing with him for 3 months, 6 months, and he's an ex-NFL athlete, and I'm an ex-baseball player, nowhere near to the same level that he was, right? He actually played in the NFL. I, banged around the minors, unaffiliated ball for $800 a month type of thing, right? So he's up here and I'm down here, but we're just trash talking and hanging out. I walk into my apartment one day and my roommate has flipped this house on TV, and I'm like, no way, I play volleyball with that guy. Like, you got to be kidding me, right? And so he introduced me to the world of real estate investing. And there was a different way to do things. And my parents did a good enough job screwing my head on straight to know an opportunity when I saw it and to be open to it. And so he took me under his wing early. I mean, I was 21 when he took me under his wing and just taught me a lot about how to build wealth and how to start, right? Building wealth long term. And so I was young and I didn't have any credit, much like, a lot of young people getting in the game, really not a bunch of money and not a bunch of credit, and no idea where to start. But I knew I wanted to start buying real estate and owning it because I saw the wealth creation it did. So I wired my dad $30,000 into his bank account and didn't really tell him what it was for. And he got super pissed because he's like, this doesn't happen. I send you money, you don't send me money type of thing. But I was like, Dad, here's what we're going to do. What we're going to do is we're going to buy our first piece of real estate together. We're going to use your credit because I don't have any credit yet. We're going to use your credit and your W-2 income. We're gonna use my money. This is a no risk deal for you because I'm gonna spend all the money on this, all the maintenance, everything. It will come from me, I promise. Proof of that, there's $30,000 in your account. And so I finally convinced him, and I used all my son value, all my credit. I spent it all with my dad and got him to actually pull the trigger and buy our first asset together. And that's how I got started, right? Is I scrapped and clawed and pulled every cent I had together of all of my life savings and sent it to my dad and said, here's what we're going to do. And we bought one, and now he's got his portfolio and I've got my portfolio, and we've just built and built and built over time. Yeah, it's been great. It's changed our life. It's changed our family. Not to get serious, but he got sick for a little bit and I got sick for a little bit actually. And I wasn't able to work for a long time, actually quite a bit. I'm fine now. He's fine. We're all healthy and good. It's all good now. It's a good story, not a sad story, but I tell it because real estate helped us during that time where when my dad couldn't work, he's a dentist. So when he doesn't work, there's no income coming in, right? He doesn't have benefits. He doesn't have W-2 income. He doesn't have all of those things. He's self-employed, right? And same thing here. Like, when I don't work at Fortune Builders, when I'm not here, like I don't have a paycheck, right? And so those investments, those pieces of those assets, right? Those single family homes, those real estate investments that we smartly purchased, right? Produced income in that 6 months when I was laying on the couch and not able to move, right? Like I had income coming in. I have to worry about my wife freaking out. I didn't have kids at the time, but that's what I love about real estate. And that's why, again, I love doing what I do because we get to build, Gregg and I, we get to build that for families across the country. Like that's the special. Like, yes, the transactions are important, but it's the people and what it means, right? So that's a little bit about how I got started. So.
Paul, it's like looking in the mirror when I'm looking at you, brother. I mean, we've been such good buddies for like, it's like looking at Jason Statham. But when you talked about what matters to you and why you love what you do, and also the personal story, I don't know if I ever shared this with you, but my dad had a similar story too. And that was one of the big motivations that I had in the beginning, as far as creating these investments. It wasn't just that I was doing this, for him. It was like, if I can create a situation where somebody who can go through a health issue and can have that passive income coming in, what effect does that have on his family? My dad went through some health issues while I was in college, and that always stuck with me. And, and I was just sitting around with my dad this weekend. We were getting ready to go to the Steelers-Jags game. And, we were sitting there, my kids were there, and he was telling another one of my friends that, he is retired now. He retired at age 58. And the reason that he could do that is because of rental property investments, right? I mean, that's the real payoff here.
Yeah.
You talk a lot about the relationship. I mean, how many other friend working business relationships do you have that last over a decade, where you guys you guys have us, but it's really rare. We have probably close to 1,000 homes that we have worked together on to fill in our clients' portfolios together.
I'd say probably close to 2,000, right? Yeah. It's amazing. And we don't have any other talking about our relationship, right? Like you and Ice and Sapakis and, even Steady, right? Like I don't have I've got other business relationships that are equally as long, but none that are equally as long and as close, right? Where we hang out, when we get on the phone, it's not just business, right? Like there's that personal relationship, you care. And that's a testament to you and frankly the culture you've created because your whole staff is that way, right? Like your entire staff treats me that way still. And that's phenomenal, right? Like I love that because I have other business relationships. They're phenomenal relationships, but they're not there's not that warmth. And I'm always a big believer that you can, and it's tough, right? But I think you can if you put the effort in. Like you can win in business and win on the personal side. You can do both. And you don't have to be transactional or cutthroat to win long term. You can build that relationship. And to me, that's what I love. And that's what I try to preach that to my team. I try to preach that to all of our team as well too, is, real estate, yes, there's a transaction involved, but it's not a stock, right? It's not like it's, and there's nothing wrong with stocks, but it's just a transaction. Like a real estate, you're creating a home for someone. So there's a win there. You're creating a job for someone. So there's a win there. You're creating a job for the maintenance guy and the plumber and the electrician. You created jobs there. You're creating a An income stream for yourself. There's a win there. You got a property manager. There's a win there. There's a lot of wins that go just beyond the transaction. Like there's a lot of people's lives you impact, right? And like you guys understand that. You've been taught me that, frankly, right? With like teaching our staff to not talk about the people who live in those rental homes as tenants, to talk about them as residents, and that like all those little things matter, right? You know, and anyway, and go on and on and on. But yeah, it's rare. It's super rare to have the business side, the personal side. I mean, shoot, I slept on Sophocles' floor, right? Like that story will never go away.
And
right?
for those who don't know, one of the stories that Than tells when we're at conferences together about how he slept on my floor when we were starting back in the day. So a lot of similarities, man. Super appreciative of our friendship, our relationship. You know, you're in a position where you have this incredible perspective, right? You're an investor who has put your own money in different rental markets. But even beyond that, right, the amount of volume of transactions that you have been personally responsible for is mind blowing. Is that 500 million? Did I hear that right? I mean, incredible, right?
It's crazy. And that number probably needs to be updated as well too, because of what we've done on the commercial side in the past 24 months as well too. But yeah, it's growing up in Prunedale, California, right? Where it was a migrant farmer community, and my dad, I grew up with rice and beans, and that's what we ate. And we had the pleasure days where we had hot dogs mixed in with our rice. Like that was, top ramen noodles. Like that's what I grew up on. I'm not saying it was bad. I loved it. It was a perfect childhood. But like growing up, I never thought that would, to be able to say it's, $750 million of transactions that we've kind of done in our community. Yeah, it's even humbling to think about right now, right? Like I'm struggling trying to figure out what to say about it, because again, I think it's just part of the power of being part of something that's bigger than yourself, right? Like, and that's what I believe is like when you can genuinely set out to actually help people, and you're going to make mistakes along the way. We've made plenty, right? And not everything works out perfectly. It happens all the time, right? But how hard do you work to try to fix it? And you can't fix everything, but try to fix everything as much as you can, and admit when you're wrong. Like, hey, I'm not trying to say I'm a saint. We're going to screw up every once in a while. It's okay, right? It's not all sunshine and roses all the time. It happens. It's real estate. Things happen, right? But when you're trying to genuinely, I think, do good in the world, and you build a community around that, like there's power to it. And so yeah, it's a blessing. It's humbling to be a part of all that and see the different things, see things go right, see things go wrong, have the experiences myself. And yeah, thankfully we've won more than we've lost.
I mean, that's kind of what I wanted to hit on. I mean, we have so many folks who are joining us today. This might be our most highly attended session. Super appreciative for everybody to be here. We have an opportunity to pick your brain, Paul. I would love to do that and to share some of that perspective, not only being responsible for that many transactions, being there on the front end, but also being there on the back end, right? As that property management relationship. This isn't like a situation where you are there to help your people buy properties and then never talk to them again, right? You're there for over a decade for many of them. But you're also that person who must just get hit up day after day after day from companies who are in the turnkey space who would give their left arm to have fortune builders refer their students to those operations. Can you talk a little bit about your experience as an investor and also somebody who is holding the reputation of fortune builders really in your hand and deciding who you're going to give that to? What are you looking for when you spend your dollars, or what are you looking for in a turnkey provider? What should our listeners be looking for when they're thinking about spending their hard-earned dollars on their rental properties?
Yeah, it's a really good question. The first thing on that point is we move incredibly slow at the beginning, and then we move incredibly fast later on, right? So, we don't want to wait until all the stoplights are green at the beginning of a relationship. Like we maybe want to see 1 or 2, 3 stoplights down the road, but we're not trying to make sure all 50 stoplights and that everything is exactly perfect. Like we want to slow it down at the beginning. And what we're looking for is really, there's a difference between an investor who sells turnkey properties and a business owner and someone who understands how to run a business. And they're two very different things. And early on, we got, kind of caught up, and we didn't really understand the difference between the two, because we were focused a lot on the real estate side, the transactional side. And I said, wow, these are, some turnkey companies would come to us and they're showing us their rehabs, they're showing us their returns, they're showing us everything on the front end on the real estate. And it's like, wow, this is great. We should pursue some of this. And we started buying some of them ourselves. So we always want to buy first. So my money, Dan money's, Paul's money, JD's money, we want to buy first and test it out ourselves. And while the real estate can be really good, it's that non-transactional relationship side. So the communication, the reporting, how they treat the tenants, how they talk about the tenants to us, right? How they deal with the contractor, how they deal when things go wrong, how they handle that is more important than the transactional side for us, right? So it's two parts, all those intangible things, one part the actual real estate, right? Because yes, I want to make light of like a rehab is a lot of work. A quality rehab is a lot of work, but frankly, I'm not gonna say it's easy. That's the simple side of it. Like there's a system there that you can follow, and most people, give them enough time and resources, they can follow that system. But all those other things, it takes a lot of, it just takes a lot of money, frankly. It takes a lot of money spent, energy spent, focus spent on things that are usually a loss leader in a business, right? Like hiring staff to call people outbound instead of just handling inbound phone calls. Hey, I'm an investor and I'm going to get a phone call, not have to chase my manager. I'm going to get a phone call. Well, that takes staffing, and that staffing doesn't really have like an ROI on it usually for the first 3-4 years. I mean, Greg, you're smiling because you know exactly. You write those checks in 2 weeks. Right?
Absolutely.
Like, but that provides that experience that's so, that transparency, that experience, that level of accountability is important when you're an out-of-state investor. So that's what we look for. And that's the gap that a lot of people, or a lot of companies, I should say, who are the difference between like a really good investor and a business owner. A business owner understands that difference and understands that those are dollars spent that's going to provide that good experience for my investors. And that's where as a business owner, they'll spend that money. As an investor, they don't see that ROI, and so they won't, right? And that's a lot of the difference. We look for a lot of other things. I mean, shoot, we have a system like we do with everything at Fortune Builders. So I've got a 90-point checklist, right? Literally, it's like 93 things that we send to people. And it's intended to scare people off who don't want to spend the work to answer the questions and talk about all their KPIs and all their data and all of their internal systems and how much staffing they have. And all those things are technical data points. And then we talk about, who are their competitors in the market. We look at a lot of things. How many doors do they manage? What's their fee share? We need to look at tons of stuff. So most people make my job easy because they see that and they're like, well, this is way too much work. No thanks. I just want to sell houses. Okay, but that's not the company we're looking for. Right. So
yeah. I mean,
that's it. Oh, sorry, man. Greg, you want to go?
Well, I was just going to say the greatest cost for you guys is somebody that harms your reputation, right? So it would make a lot of sense that you go way, way slow, right? Your reputation's rock solid. There's no amount of houses out there that you guys could potentially sell with a partner if it's ever going to threaten that. But Pablo, your show, brother.
Listen, man, I was just going to say that I love where Paul just went, right? Because I'm not a savvy real estate investor at all, right? Like everything that I know from real estate is what I have learned from being on this side of the Zoom call for the last 10 months. But as a business owner and somebody that came up managing Fortune 500 companies and whatever, the operational prowess and you keyed on it perfectly, man. Like the offense that Gregg and his partners invest in, right? Like the outbound stuff and the culture and the ability to like invest in these business concepts that aren't bottom line. And I equate them. I was just describing JWB to my brother-in-law last night. And I'm like, yeah, man, like their property management is a loss leader because they make their money by getting you to invest in more and more property. So they're trying to give you a good experience. It's not it's this like uncommonly wise tactic of longevity that I always hear in everything that they do, man. So I love exactly how you answered that. And I want to also key in on something else. because David Verktold asked us in the comment. He basically asked, how do you look for a turnkey provider, right? So
Yeah.
Greg just asked that question, but he also asked, what markets do you look in? Like, what do you look for? So you've explained to us what you
Yeah.
look for in a company. Can you explain to us what you look for in a market when you are looking to invest as in a turnkey provider?
Sure. Yeah. The answer is probably a little bit different than what most people are expecting, right? Because yes, there's a ton of KPIs there. There's a ton of like actual factual things we need to look at. What a KPI is, for those who aren't familiar, like key performance indicators. So like, you're asking what markets normal people are going to. Okay, well, where's the economy doing well? Where's a good rent to price ratio? Where's, all of those things that are like economic indicators. Those are super, super important. But I'm gonna, where we go first is believe it or not, away from the market, and we go to, if you're asking me the question of like, where should we look and how do you figure out where you should be buying? Really, it all comes down to investment objective, in my opinion, right? And that's frankly where we start with every single one of our students, where our system starts, how we've built 5,000 families. Real estate portfolios, if we always start with investment objective first, right? Which is a little bit counterintuitive. In real estate, we often want to start with the house itself, the transaction itself, and we work our way out. It's like the inside out. It's like, ooh, opportunity. It's like the squirrel find, ooh, great shiny object. Ooh, there's none, right? I found a house. Oh, great. Let me figure everything else out. Who's going to manage it? What kind of neighborhood is it in? What are the rules and regulations around that neighborhood? Okay, who provides jobs in the area? But we started with the house and we're working our way out. To me, that was always backwards, right? It's like, let's start with the most macro thing first and then work our way in, right? And the most macro thing is like, well, what are you looking for, right? Like, what do you want? Because that then helps determine what markets you should be investing in, or what markets may be better for you that I wouldn't invest in potentially, right? Not saying it's a wrong market at all. It's that market may not produce what my objective is, right? Meaning, like, is your objective tons and tons of cash flow and you don't care about growth? Is your objective growth and you don't really care about cash flow? Is your objective where you just want a little bit of everything? You like that middle of the road stableness of everything, super stable or willing to take risk. What your objective is, in my mind, the clearer you are there, then when you couple it with the knowledge and education of, well, how do various markets across the country produce? What do they do? How are their economies? How are their local regulations? How is their cash flow and all those numbers of what rents to prices are and all that kind of stuff? Once you know what your objective, what you're looking for, and you have that education as the second piece, then you can kind of becomes fairly simple and straightforward. Oh, okay. I'm a super heavy cash flow investor and my risk tolerance is like a 2. Okay, you want a stable cash flowing market. You don't care about growth. Cool. Like, let's go there. And then it becomes a lot simpler. Whereas people, they make it more complicated. I think it needs to be, right? Like, you don't have to, you start with yourself and really get narrowed down on what it is you're looking for. And the best thing to do is work with professionals who understand it, can explain to you quite simply, well, what makes a cash flow market versus a growth market, and what's a good market in between, and what are the numbers I should look at? Because I know what I'm looking for is the first step. Then when you get that education, you get a company to start tell you, well, what does your market do? What do you produce? You can quickly say, okay, that may be great. You may be a phenomenal company, but you're not a company. And that's okay, because you know what you're looking for, versus like just getting caught up in the emotions of, well, my uncle invests in wherever, so I want to invest there too. Is it great for your uncle? But you might be 24 looking for growth and he's looking for cash flow. Probably shouldn't invest in that same type of thing. Does that make sense?
It does. It does. And something else too, which I know is what you subscribe to, is that for the same investor, multiple markets might fill a specific purpose within that portfolio. Paul, how many different markets are you investing in? And can you maybe tell a little bit about why you make certain decisions to go to certain markets?
Yeah. So we like geographic diversity in our portfolio, in Dan's portfolio, my portfolio. We believe in, we don't have a lot of diversity. In fact, stocks and oil and gas and gold, we don't diversify that way. We diversify your real estate. but we diversified geographically, right? And to build a well-rounded portfolio, I believe in a little bit of geographic diversity is a good thing. And what we look for is a little bit of balance of both. We want that balance. We love, we're in, gosh, how many markets now? I think 11 markets on the single family side across the country. We're fairly selective with that. And what we're looking for is we don't want those huge, massive outliers on either side, right? Like we usually don't invest in, the West Coast because it's very low cash flow, extremely high growth. Well, that's an extreme. We don't want extreme. We kind of look for that solid middle of the road, what everyone looks for. They want some growth with some cash flow. They want both. Everyone wants their cake and eating it too, right? And so the Midwest and the Southeast, in our opinion, provide those economies and those structures provide both, in our opinion, much better than like the West or the upper East Coast and the Northeast, just from what we're looking for ourselves, and usually what our community is looking for is we believe in cash flow, right? We believe we like some growth over time. We think real estate historically, if you buy it the right way, you can take advantage of some growth over time. But we're not looking for double-digit insane growth, double our money in 2 years. We're not looking at Scottsdale pre, 08, where it was like doubling and tripling. That's not what we want from our investments because we're fairly conservative. We like the slow steadiness of growth over time, which is why we're fairly selective and why we like those markets that we're in, like, Jacksonville, for example. It's still Florida, so it has phenomenal growth over time. But that's why we're not in like Miami, right? Or we're not in a lot of areas. Nothing against you, Pablo. I think you're down in Miami, right? I love
no,
Miami.
Not anymore.
Good. Not anymore.
I'm all in on Jacksonville, man. Yeah.
Okay. But Miami doesn't. The prices are too high to where the rents are, and so it doesn't produce for me that spread. The lower I can get the price and the higher I can get the rent, to me that's a bigger spread for me. So I like markets that are, more Midwest style markets where prices are low and rents are high comparatively, but then you throw in, oh, well, it's still Florida, and so Jacksonville still grows over time. Okay, wonderful. That to me, again, this is very high level. There's a lot more to it, but that to me is a market that's attractive to me and that kind of thing. There's a couple other markets across the country that do that type of thing. The Kansas Cities, the St. Louis's. There's because that's just one factor. Then the second factor is you got to have the right team, which we talked about, in that area to make sure it does all the things you want it to do. Because there's paper returns, and then there's actual returns in real life, and people get you those actual returns. It's not the actual asset itself gets you those returns. The people who find the tenants, who collect the rents, who do those things and keep maintenance down. It's people who do that. That's the difference between paper yield and actual yield. So it's, you got to find the right market that fits your objective, and then you got to find the right team and the people who are going to help you execute that plan, right? So.
Super complete answer, man. That was awesome. Paul, I'm going to put you on the spot in a second, but I want to just take this moment. We're at a half an hour. I know that this is a very highly attended call. I know that we have probably some new people in our audience today. So I just kind of want to touch base that, we're going to go a little further. Are you good to go another maybe 20, 25 minutes, Paul?
Yeah, I cleared my morning for you guys, man. So.
Okay. Well, we'll see. It's going to be a Paulathon. So I just want to say, right, like I'm going to ask you a couple more things. We're going to open it up to the questions in the Q&A. If you haven't put your question in the Q&A, go ahead and put it in because we're going to go through those right now. And then I also know that you have, you got a little tactic you've been using lately that we're going to key in on, in a second, right? So I just wanted to tease that till the end.
Sure.
If everybody, if you know what I'm doing here. So, All right, Paul, I'm going to put you on the spot. So I know we have a lot of people here. Many of, right, like we see our usual regulars. We have like 20, 25 regulars that come every call, but I have to assume that we have some new folks here, and they have to be asking themselves, they're asking themselves the questions that we've been asking you, but I think specifically they're asking themselves, is JWB for me, right? So if you could ask, if you could answer kind of like, who is the type of investor that you would recommend? Like, what is the investment objective where you would send them to JWB so that people can maybe like self-select to see if that makes sense for them?
I think the investor, frankly, it's what immediately pops to mind is my father, right? So someone whose primary objective is stability, and stability just comes to mind, right? Like if your objective is you're sitting there and you're thinking like, I want to know what they're telling me is going to happen. I want to know that those numbers on those PE sheets are going to be there with, I mean, real estate investing, there's pros and cons with everything, right? You're going to have years that are better and worse. That's just the name of the game. But I have yet to see a company that's as stable and consistent over time as Gregg's company, as JWB, right? And to me, that's the ultimate compliment, right? Because to me, that's what most of my investors, when you really scratch the itch and go down beyond surface level of what are you looking for? Because in my opinion, to nail down investment objective takes a while. Like it's not like a 10-minute conversation. That's like multiple hours, multiple weeks of really diving in and really sitting down. And you're gonna tell us what you think you want, and then we're gonna ask questions after question after question to really get and put you in situations like, okay, you say you're okay with a little bit of volatility and you want some higher returns for that. What happens when your property goes vacant for 6 months? Are you actually okay with that? Well, no, I want that cash. Okay, so let's narrow it down. Like, let's really get to, you actually really want stability and consistency in your cash flow and consistency in your growth over time, versus what you're telling me you originally wanted is you're okay with some volatility. No, you're really let's get to what you really want. And so to me, I've seen that's where JWB really thrives, in my opinion, is that stability and consistency of the cash flow, but also the experience. Not everything's going to go right. That's going to happen, right? Like I've had maintenance and expenses. It's going to happen at some point in time. I guarantee it. And there's nothing wrong at all. Tell it to Gregg's face. I think Courtney called me 4 weeks ago. Stuff happens. I've got, a fence that I got to fix. It happens. No big deal, because I have proper expectation at the beginning. But I know over time, my assets, and it's been proven, my assets perform like exactly spot on to my PE, or outperform spot on to my PE, right? PE means property evaluation sheet. So it's a long answer, but I think that's the investor I would really encourage. They're the cream of the crop, right? When it comes to experience, communication, transparency, and just stability, right? Like if you're looking to triple your money in 5 years, this type of investing probably isn't right for you, right? And that's okay. If you're looking for, I want extremes of, 20% growth over, no, that's not what this is. This is long-term wealth building, long-term, you're going to get cash flow, absolutely. And you're going to get growth over time, but you're going to get a consistency of your experience and product, right? Which is in my world, people come to us because they're sick and tired of getting the yo-yo of the stock market, right? You get 12% 1 year and -6, 4, and 12 and 20. And then, if you just want, hey, give me 6% growth year over year, I'm super happy. Boom, like that's a perfect person. I would say here, Gregg, go do your thing, right?
And Paul, I mean, your answer was if I could have put a perfect answer in your mouth, it would have been stability, consistency, experience. Because, I remember when we were starting this company, we looked at rental property investing. And when you run the numbers, especially if you factor in growth over a long period of time, the numbers are incredible.
Yeah.
Right? The numbers are just incredible. But there are more people out there who are scared to invest in rental properties than there should be. And the reason is because they were scared. They haven't had a good experience. They were scared of the experience. So our mentality has been, listen, I mean, this is going back, 15 years ago when we started this thing. It was like, if we can just nail the experience, the numbers take care of themselves, right? The numbers are better than what you're going to get in other asset classes, especially if you factor in using leverage, especially if you factor in tax savings and other profit centers, right? The numbers are going to take care of themselves. We got to nail the experience. And, you nail the experience when you hire well, when you staff appropriately. I mean, I tell people who are asking about using a different provider, what questions should I ask? I say, ask them how many people they have in their office. I mean, there's a reason that there aren't many turnkey operations out there that have 80 people in their office. Usually it's, 2 or 3 people. They're virtual. They're riding around like looking for properties, right? You guys know I'm here every Tuesday and Thursday on the show. I'm not riding around looking for properties, right? We surround ourselves with incredible people who each manage their part of the business here. But unless you make those investments, you are not going to nail the experience. And in the end of the day, the experience is what matters. That's what keeps people coming back,
Yeah.
I loved your response, Gregg, because I was just thinking, I'm like, man, Paul literally just spoke out the blanket that Gregg loves to tuck himself into at night. Like it was just a a perfect reflection of how I know you like to feel like, right? So I thought that was great. So let's get into some of the Q&A, right? We do this every Tuesday. We have guests. We love to have our audience be able to interact with the people that we're bringing on, like Paul. We also have clients and stuff like that. So anybody that's new here, I encourage you to come back. I encourage you to join our Facebook group. I'm going to put it in the chat right now, but jwbfacebookgroup.com. We have over 1,800 investors there that, Gregg goes live in there. We interact. It's our community. We used to call it our secret cool club. It's not a secret anymore. So it's just a cool club. You're invited. All right, Paul. So we got Lee Bishop, who asks, Paul, do you participate in selecting the supermarket and business buildings as well as apartment investing that Fan and Paul put out to the Fortune Builders group?
Yeah, so I'm fortunate enough to be able to say yes, right? So I'm a partner on that side of the business. That side of the business for us is called Equity Street Capital. You can go if you want some more information on that. It's equitystreetcapital.com. And that's our commercial real estate investing business, right? Where we try to frankly replicate what Gregg has been doing, which is great, on the commercial side. So yes, I'm involved. We do some retail shopping centers. We do apartment buildings. We do some office buildings, and we look for exactly kind of why I get asked to be on a lot of different media things, and I say no, frankly, to almost all of them. But when Gregg asks, I say yes because he's Gregg, right? And he's we've got that 10-year relationship, but also you've helped change our lives, right? So of course we do whatever you want me on here, brother. Let's go. But that's what we're looking for. We're looking for best-in-class operators like Gregg, who do those different asset classes, right? And it's one natural kind of follow-up question to that is like, oh, would you recommend single-family homes or commercial? Where do I start? What do I do? Again, it comes down to investment objective, right? Because there's pros and cons with everything. And this is what I tell people all the time is there's this preconceived notion when people come, a lot of our students come through, there's a preconceived notion that, oh, it's like you start in single families, you graduate to commercial, and you graduate, you always go up. It doesn't have to be the case, right? I've had people go down, right? And it's not necessarily down. And that's the thing is I want to dispel that myth of like up and down or better or bigger is better. No, it comes down to objective, right? I've helped a lot of people help sell some of their apartment buildings to get into single families because it just fits their objective better, right? And our job is, we believe in real estate as an asset class across the board. So yes, we invest into all kinds of different things, right? Some of my best investments still to this day, even though I'm a partner on the commercial side, I love the commercial side. A lot of my net worth is on a commercial side, but some of my best investments to this day are my single family homes I bought when I was 21, 22, 23, right? And we can talk about why that strategy is if you want, anytime you want. But short answer is yes, I'm involved in anything that has to do with our long-term hold. That's not a flip. I'm fortunate enough to have some fingerprints in it.
All right, right on, man. So Stephen Block, aka Stevie B, active member of our Facebook group. Welcome, Steve. Paul, how do you feel about using solo Ks for acquiring rental properties?
Yeah, great question. I love it is my short answer, right? I love it. I think it's a phenomenal tool to use. My disclaimer is like, talk to your CPA, talk to your financial people to make sure you're understanding that how your solo K is set up, because that understanding and that knowledge is very, very important. Anytime you're using retirement money, which is what a solo K is, for everyone who may not know, a solo K is a 401k that your company, so if you're a real estate investor, you're a business owner, you have a company that you own, right? You can create a retirement plan for yourself through your company, a 401k plan that happens to be self-directed because you own the company. You can set up a 401k that's self-directed. It's AKA a solo K. Phenomenal way to pick up real estate, phenomenal way to be in a tax shelter and do it perfectly legally, and you can absolutely invest in real estate from a solo K. I love it. We teach a lot of people how to do it. You just need to know, you need to know what you're doing. You need to have the education or have a pro alongside you who can teach you that. For example, you can't commingle funds, right? If you're in a retirement account, you got to think of that as like a swimming lane, and if you go out of your swimming lane into your personal side and you start mixing personal funds with your retirement funds, All of a sudden you got the IRS, not happy with you. You went outside your swimming lane, you crossed the lane. It's like Ghostbusters, don't cross the streams, right? Don't cross the stream. So you got to keep in your lane, and you have to be important. It's important to stay disciplined with it and make sure you're working with the right people who understand that as well too. Where if you have a maintenance bill pop up, the $600 to fix a fence, I can't just write that check personally or send it from my credit card or whatever. Like that money has to come from the solo K. So I love it. It's a great strategy. I myself use it. We teach thousands of people to do it as well. This fly is gonna get out of here for a second. But you got to do it the right way, right? So you got to have a good team around you, or really be educated yourself about how to do it to make sure you stay good with the IRS, right? So,
Greg, you got anything you want to comment on there for anybody that's a JWB investor, and how to approach the solo K stuff and how you would recommend it?
I'd largely, follow just what Paul was saying there, but I do see the next question from Stevie B over there asking a little bit more of a detailed question. He's asking, is there any merit to refinancing fully owned properties in a solo 401k to extend the portfolio, or would it be better to sell the property and take the distribution from the solo K to purchase additional properties using conventional financing? For this specific question, Steve, let's go ahead and let's talk with my team to make sure we fully understand, everything that's going into this. But one of the things that I will point out is that financing for a solo 401k is completely different. Your conventional financing rates are going to be so much better, especially now in the lending environment that we're in. So that would be a big determining factor of which way we guided you to go with your specific question, because if you can get that money, take a distribution, assuming that you're after 59 and a half years old, you're not going to pay a penalty to take that distribution, get you into your non-qualified funds, meaning money that is outside of your retirement account. You can then take advantage of conventional financing. So probably going down that route, but again, we've got to see the full picture and be able to help you in the right direction there.
Yeah, I'll throw something in there, Pablo, if that's okay. Like I teach a lot on stage, or I used to pre-COVID, right? We teach a lot on stage, and we do our live events and our boot camps and everything. And if I've met anyone who's a master's student here who's actually on the call, hi everybody. But my favorite answer for all of you who know is like, what's my favorite answer to this, Greg? It depends, right? That's my favorite answer. It depends. And we get the whole crowd to come up and say, because you get those specific questions of, in Stevie B, it's a great question. But the correct answer, in order for someone to give you the really correct answer, is going to be so dependent on you. How old you are, how much cash flow you need, what your investment objective is in the first place, right? Like, just because you can pull money out of a deal and potentially expand, should you, right? Like, let's go back to why you're doing this in the first place. And those answers are unique to everybody, right? So there's the technical side of what you can do, and then there's the objective side of should you, and does it make sense for you, and what your other investments are, how much money you have elsewhere, how much money you have in real estate, how old you are, why you're doing this, are your kids going to college, is it to retire? All of those things factor into should you do that, which is a lot bigger of a conversation. And so in my mind, it's like anyone who's not acknowledging that, like Greg said, hey, let's chat with the team and really figure this out first. Like, I love that answer. And like, I want to just preach from the rooftops, whether it's us or anyone you work with, they should be taking that time and slowing that down with you, and to say, let's figure out this is really the right thing, versus, yes, let's do that. Let's take the money. Let's buy more houses, because that's the business answer, because frankly, we're going to sell more houses. And that's not always the right answer for you, right? So let's slow it down first. Exactly like Greg said, I love what Greg said. Hey, let's chat with the team first, because there's a lot of things we can do. Let's figure this out, right? So perfect. Well done, Greg. A+. Well done.
Appreciate you, brother.
Guys, you guys are a well-oiled machine over here. And I'm just going to add to that. If you want to chat with the team, go to chatwithjwb.com. Easy peasy. Pick out a time and you'll get on the call with the mics. Paul, I want to ask you about that little tidbit of advice that we spoke about last time. First, I want to acknowledge the group. Something really cool is happening in the chat where there's just like all these like kind of impromptu testimonials happening. Really, really awesome, of people talking about having met you, and other people talking about like their experience with JWB. Really, really appreciate it. Denise, Lee, Roger, who else is out there? Aaron is giving us some good love. Sue's giving us some love. Stevie B, of course. Really, really, really appreciate these testimonials and what people are putting in the chat. And if you're listening to this call, you haven't looked into the chat, I invite you to check it out, right? Like, I don't have to, beat our chest too much about it, but we will. So, all right, Paul.
Yeah.
You and I spoke about something that you've been doing recently that we haven't
Yeah.
spoken much about on the Not Your Average Investor show that you are using as a tool to really supercharge returns. I'm not going to mess it up by framing it because I don't know what it is really. So I'm gonna give it up to you to kind of explain it if you can.
Sure. So this is a strategy that I don't want to take credit for it all. Like, investors have been doing it since day one, right? And one of the beautiful things about real estate is there's so many different ways to make money, in my opinion, right? There's hundreds of different ways to make money in real estate. You just have to figure out which ones are the right ones for you, right? And that's part of investment objective, in my opinion. But for me, my ultimate, and probably for many of you sitting there listening to this, your ultimate in real estate investment or any investment would be, let me own something basically for free, and it makes me money every single month, right? Like, that's what the definition of that is in my mind. That's an infinite return, right? That's the perfect investment. Let me own something where I didn't have to spend any money for it, and it pays me every single month. Well, that's ideal. That's truly passive income, and it's an infinite return because I don't have any money in. And I've been able to do that on about 3/4 of my portfolio now, which is insane. So how I've done that is I've utilized what's called a cash out refinance, right? So the caveat there is, of course, I put money in at the beginning, right? I bought those assets. I bought single family homes. I've invested into assets, right? And so, yes, I put money out to do that. I put my down payments, my $20,000, $30,000, $40,000 down, whatever it is per house. And they cash flowed over time. But what I did is, and I do this on all of my assets every single year, right? So part of my, I failed calculus in high school, right? And I didn't really get good at math until math started making me money. Let's be very real. I like money. So when math started making me money, I got good at it. I learned how Excel works. So I just built a simple Excel. It's just a simple. I built an Excel portfolio or formula. It's just an Excel table that I just put some inputs in, and it kicks out and tells me, like, when I put in what I bought it for and what I owe on it to the bank, right, and how much cash flow I'm getting currently from it. And then I put some other inputs, and I go online. I do this every single year as I look at my assets, and I get a rough estimate of what I think they're worth now, roughly. So you can do this in 5 minutes. Redfin, Zillow, you call Gregg and get, his team. Hey, roughly what's this worth, right? When you're getting your once a month phone call, have that conversation about once a year. Hey, Courtney, or, my girl's Courtney for a long time. That's why I keep going. She's awesome, right? Courtney, roughly what's Rogero Drive worth, right? Just give me a ballpark. I'm not going to hold you to it. Just give me a ballpark. And so I can put that into my formula. And then I can figure out, I've got banking relationships. I say, hey, what's my percentage you can give me if I refinance this thing? What's the percentage you can give me this? Oh, I can give you 70% of its current value. You do the math and figure, okay, well, if this has grown over time a certain amount, I've got equity in that house that's not producing me any more money. No fault of Gregg's team. Gregg's team's doing exactly what they said they're going to do. They got a house, you bought it for 150, you're going to get $100 a month of cash for whatever it is, right? It's been chugging along, doing it. You've been paying the bank back every single month. And you look up 3 years later, 5 years later, 7 years later, whatever it is, and that $150,000 house now may be worth, round numbers, 170, 180, 100, whatever it is, right? When you do the math, and the math is fairly simple, you figure out, well, the bank's going to give me X. Can I get all of my money that I put into this, my 30 grand that I put in a down payment, can I get 30 grand back if I refinance this asset? And the answer on my portfolio was yes, about 70% of my assets. So kind of backing up, I put 30 grand in. 5 years later, 7 years later, 3 years later, whatever it is, I get 30 grand back. And wait a minute, I still own the asset. I got all my money back, and I still get the cash flow from this. My return is now technically infinite from that point on, which is crazy to me. Like, there's no other investment that I've come across where I can do that. Wait a minute, I'm going to give you $1, and a couple years later, you're going to give me my $1 back, but I still own the asset. How does this work? And you're still going to give me cash flow? That's phenomenal. So that's why cash out refis for me have been a godsend, right? Some of my single family assets have been the best investments I've ever had. Because some of them that I bought, and I've this is the thing about real estate. Time is your best friend and your worst enemy, right? When you own it for a long period of time, you get this advantage. So some of my assets I bought 9 years ago, I've done this twice on the same asset, right? So I got infinite return on some of these assets 3-4 years ago. They've grown so much again, and I'm getting the cash flow every single month, remember? But I go back to the bank and say, hey, let's do this again. Let's rinse and repeat. Now I've made 2 and 3 times over the money I put in, and I still own the darn thing, and it's still cash flowing for me, right? So that's infinite return. So for me, that's my whole goal. I want as many infinite return pieces of real estate that I can get in my portfolio, right? Because what am I going to do with that 30 grand I get back when I refinance this thing? What do you think I'm doing? Who am I calling? I'm calling Gregg and I'm saying, hey, give me another one because I want to do this again. Because my goal is to have 3 to 4 of these per kid, right? And then per grandkid that I don't have yet. My kids are 4 and 1, right? But now we're at the stage where it's like, okay, let's get 2 or 3 of these assets per child and then per grandchild and in the future. And then I got my brother's kids. So we can get 2 or 3 per kid. Well, that'll pay for their college education, right? And so for me, this is a strategy that I really, really, really liked. It lit my world on fire when I figured out how to do it. I'm like, wait a minute. I was trying to calculate the return and I broke Excel because Excel is like, they can't calculate an infinite return, right? So for me, I love it. It's a business strategy I've used for a long, long time. The cash out refinance. I mean, there's caveats with all of it, right? You got to be able to qualify, in a non-retirement, or using non-retirement dollars. That's what the conventional financing usually works. In retirement accounts, there's different strategies you can use. You can use the same concepts, but in retirement accounts, you can do it a little bit differently. But it's something I even went out to our whole community on and taught them and showed them how that calculator works. You put in 4 or 5 inputs and it'll kick out to you, does your property work in this? Can you get all your equity back? I plug in 4 or 5 inputs and boom, you get the answer back out like, yes, you can refinance and get all your equity back out. And here's your cash flow. For me, that infinite return is just, I love it. It's phenomenal.
Paul, going from failing calculus, as you just let us know you did, to breaking Excel because you figured out how to replicate infinite returns, that's quite a journey, brother.
I'm not here for a long time. I'm here for a good time.
Hey, if you're like me, we talk about how I get excited about tax savings. That sounds like the best day of time you could have, breaking Excel with infinite returns. A couple of points there that you mentioned there, right? The combination of smart, inexpensive, readily accessible leverage, as well as an asset that over a full market cycle does go up in value over time. Those are the 2 things that Paul's talking about here that have led to this type of strategy for him, which is going to pay for his kids and his grandkids' college funds, and probably a whole lot more because you started doing this so young. But doing this while you're so young is like putting gasoline on it as well, right? I mean, that is probably just the most impactful things that you can do as a young investor. Start letting these compounding nature of rental property investments, along with leverage, along with future growth. And the reality is you don't get growth at the same rate in every market. That's one of the reasons people come to Jacksonville, is because our growth rate is higher than most markets out there, higher than the national median, and higher than most cash flow markets out there. And that's why this strategy can be used here, all things considered, used here probably more than just the straight cash flow markets out there. Now, there's benefits to the cash flow markets as well, but growth is really nice, especially when you use it with leverage.
Yeah. And one of the things I love too, Gregg, since you love tax savings, right? So the beauty of this, because again, this strategy is specifically for non-retirement accounts. So when you're using that, when I get that $30,000 distribution from the refinance, right? My house was worth 150. Now it's worth, round numbers. Now it's worth 200. And the bank's going to give me 70% of that, right? And I'm going to net, hey, I put 20 grand in, and I'm going to get 25 grand back. So I get all of my money back plus a little bit. Do I get taxed on that 25 grand that I get out of my cash? No,
you don't.
Right? So it's like, wait a minute. So my wife's sitting there like, okay, well, 40% of that, we got to put it aside for taxes. I'm like, honey, not with this, right? Not with this, which is cool, right? So there's a lot of cool things. I showed it to my dad and it blew his mind to the point where he's like, that's got to be illegal. There's no way you should be able to do that, right? Like, wait a minute. How does that work? Like any other asset, like you have to give up ownership of the asset if you do that eventually. Like, wait, you still own it? I'm like, yeah, Dad, like, here's how it works, right? Like, I'm not breaking the law. Here's, it's the same IRS tax code everyone has to play by. You just gotta learn how to use it the right way. So yeah, I love it. I love it. It's been great.
I wonder if there's a ranking on dad tax advice and where that has to be illegal. Lies in that one, right?
Yeah.
All right, guys, we're up on an hour. I'd love to ask like two more questions, reward some of our regular attendees here to get it in. All right, cool. We're gonna do that real quick.
Yeah. Love it.
Zach Correa, welcome, Zach. Aloha, Zach. Actually, he says, aloha, Paul. Happy Thanksgiving. The dream of financial freedom is a great one, and we know it's possible to achieve it through passive income and rental real estate investments. It's something we have seen time and time again with fortune builders and JWB. That said, real estate investors in the pursuit of their financial goals often overlook what we believe is the absolute most crucial part of investing in real estate. What do you see as the crucial aspect of passive real estate investing that people most overlook? P.S. Once the pandemic is over, we need to set up a Fortune Builders versus JWB beach volleyball tournament. And I'm super in. Great.
We're all in there.
Super in.
Love that. Considering Dan's wife used to be a professional beach volleyball player, and Dan and I have a decent athletic career, I think we might have an edge on that one. Even though I'm 5', we might have.
I may have to adjust the odds then based on Dan's wife
part,
but me and Greg got you guys. All right.
That's right. Let's throw down the gauntlet.
Let's go.
So
Paul, yeah, the thing that most people overlook.
I think most people overlook the fact that this is not this isn't one and done. You know, your plan, your strategy, your investments, as much as we make them, try to make them as passive as possible, it's not one and done. One passive investment is not going to change your life, right? Even two passive investments probably aren't going to change your life. It's it's almost like a lifestyle, right? But it's something that you do need to pay attention to. You do need to look at. You need to inspect what you expect, right? I'll use that from one of my. That's a Kent Clothier line, the owner of Memphis Invest, right? I love those guys. He talked constantly about inspecting what you expect. So on your passive investments, dig in there every once in a while and inspect it. Make sure it's going the way you want it to go, right? And hold the people accountable. Whether it's Gregg's group or any other group, hold them accountable to all of those things. And they should welcome that. They should love that. But the other thing is I kind of liken it to, there's like two parallel railroad tracks in my mind, right? There's the active business and the passive business. And to get where you want to go, you usually need both. Your active income source feeds your passive income investing, right? And so you need both to ultimately get to where you want to go. Most of us probably have a goal of a dollar amount per month that we want to live off of, or a dollar amount that we want to give to future generations, right? Or whatever it may be, whether it's legacy or financial freedom. Now, like, you have probably a dollar amount or some kind of goal you want to get to. Well, if you're fortunate to have $2 million, $3 million, $4 million, $5 million already in the bank somewhere, wonderful. You did a really good job on your active railroad track to get there, right? Wonderful. Now you can really focus on the passive. Great. But for most of us, the average person, that's not the case, right? Like, I don't have $3 million in the bank just sitting there. I wish I did. Greg probably wish you did, right? Probably wish you did. None of it are in that case, right? I want to speak for you guys. I'm definitely not there, right? So I've got goals still that I still want to achieve. You're always going to have goals, but for us in this game, in my mind, the active is the engine or the fuel that feeds the engine of the passive, right? So you need both, right? So on the fortune builder side, that's why we preach a lot of both, right? You should be doing both. It's ands, not ors, right? Be an and. Do both, right? Do a Burr method rental, right? Buy it, renovate it yourself, refinance it yourself, and then do all the work yourself. Do a rental actively. Great, go for it. Just go for it. You need both. You need and in your portfolio to really achieve financial freedom. I think you need both. It's an and thing, right? Two parallel railroad tracks to get to where you want to go. Versus, it's not a one and done. There's not a red pill, blue pill. This is real life. It just doesn't happen overnight, right? And if you are that person who has 4 million, 5 million in a 401k and you can roll it over, that's because you spent so long on your active railroad check that now you can focus on your passive. Cool, great, wonderful, reward yourself. But it's a both type of a thing. Does that make sense? I mean, Greg, you may have a different answer, but that's my answer, right?
You're absolutely right. I mean, you're describing my path, right? It's been active and passive all along the way. The active feeds the passive. I'm totally with you there. I mean, what I would add that most people overlook as well is the why behind the investment, right? There are a lot of other ways out there that you can go and spend your hard-earned dollars that are a lot more fun than buying a house for somebody else to live in for 4, 5, 6, 7 years that you are never going to see, right? So if you are consciously making that decision to put your hard-earned dollars into an investment that does just what I talked about, you're buying a house for somebody else to live in, there better be a big long-term reason that is super beneficial for you. And most of the time, for most of us, that is well beyond financial, right? That may be, as Paul was talking about, how he's going to be able to provide college education for his kids and his grandkids, right? I mean, that is incredible, right? That's not a dollars and cents thing. That's why he's here, to provide for his family and his future generations, right? That's not so much a financial goal, right? There are other folks that we've been able to work with that have freedom goals, right? We have one client that we talk about often, Liz and Steve, and their why they came to us was they had this dream of being able to sell their primary residence that they lived in so that they can go and buy a sailboat and travel around the world, right? And if they accomplished a little bit more of a financial goal, would that have mattered to them if they couldn't go and take this trip around the world? Absolutely not, right? For us at JWB, we look at these rental properties as a widget. And that might sound kind of weird hearing that from me, but that's really what it is. Rental properties happen to be this tool that then we can then use to change people's lives, right? Because we have become great at doing this and taking care of your hard-earned dollars, we can go and build a house for a veteran like we've done the last 2 years. And I can tell you that getting to meet that veteran and having him shake my hand and cry, and we cried together, him telling me about how much this meant to him, was so far beyond any type of financial measurable goal. So it's really not about the rental properties at the end of the day. It's about the why. I think a lot of people overlook that.
Awesome, man. That was really, really great. I'm seeing this as like its own piece in social media already, because that's how I think. But anyways, so final question. I want to reward Miguel Angel Sanudo, who's with us from Spain. He's staying up late, right? And he joins us all the time. He's got a really great question here for Paul. What do you think if we'd like to diversify our portfolio through real estate investment trust ETFs? Would it be a great way to gain exposure to the global and U.S. real estate markets instead of being stuck in one city? I'd love to hear you guys, both of your thoughts on that.
Yeah, Greg, you want to go first? You want me to go first?
Yeah, I'll go there. My candid answer is, if diversification is what you're after, you don't have to get that through a real estate investment trust. You do get that sort of built in, but there's a lot of other advantages that you don't get because you're not actually owning the asset. So either buying rental properties in different markets is a way to get that diversification, but there's even simpler ways too. There are syndications that you may be able to invest in, private placement funds that have this sort of built-in diversification, and you actually own the asset. And so your control is it is definitely a lot stronger when you invest in either of those two things that I've just described. They're either syndications or actually owning the hard asset. And there's a lot of other advantages there. So from a risk-adjusted return perspective, I would think that a real estate investment trust is not where I'm putting my money. I think there's better options.
Yeah, I think you hit the nail on the head, Greg. My brain immediately went to, hey, again, you sound like a broken record. It depends, man. If that fits your investment objective, go for it, right? Most of the investors I talk to, it doesn't fit their investment objective because they get into real estate because exactly what Greg said. They like the fact that they can control things a little bit more, right? most of my investors and students, they have and come from a stock portfolio or a normal asset kind of portfolio. I say normal just because that's people outside of this community think of as normal, right? You got your stocks and bonds and mutual funds, but you really have no control over it, right? Like, we're able to pick up a bunch of retail shopping centers because their stock price of these REITs that own them are getting crushed, even though the underlying actual real estate is performing beautifully. It's performing, it's cash flowing, it's growing, it's wonderful. But their stock price is getting crushed because of public perception. So we're able to come in and buy a performing asset at a great discount because their stock price is getting crushed. To me, that's like an alternate universe. That doesn't make sense, right? So to me, it's like it's control, and when you have, I like the fact that in real estate, I'm not a control freak in most areas of my life, but I like to know what I can control my money, right? And so for me, if that level of diversification and like truly hands off and you don't want anything of control whatsoever and you're okay with the ups and downs of public perception, great. Again, there's 100 different ways to make money plus in real estate and ETFs and that kind of thing or REITs. Wonderful. Go for it. If that fits what you're looking for, dude, full stream ahead, because hopefully that puts you on your path to get you where you want to go. Wonderful. That's what we really care about, right? But when you scratch a little bit below the surface, if control and a little bit of you can build your portfolio how you want to build it is part of your DNA and how you're structured and what you like, then I would say that doesn't hit that objective. Our real estate ETFs and like doesn't hit that objective. Not right nor wrong. I'll be very clear. I'm not saying don't or do. I'll be very clear. It's different. Everyone needs to make that choice, but be educated and be knowledgeable about what those choices are. And again, it goes back to investment objective. Once you get super clear on that and what you want, then once you understand your options, then you can make that decision whether it's the right thing for you or not. Right.
I'm not gonna lie, I was nervous to ask that question, but I had a feeling that you guys would over deliver on that, and it totally crushed. That was really good.
I love that. That's a great question.
Yeah. That was cool. That was cool.
Yeah.
Man, Paul, this has been amazing, dude. Been on for an hour and 13 minutes longer with us earlier while we were chopping it up and making fun of each other, man. It's really been quite a pleasure. I am always, as always, on Tuesdays and Thursdays, humbled by the fact that 73 people joined us for over an hour. 60 people are still here listening to us. That opportunity is something I really, really don't take lightly. I want to thank everybody that's been here. I want to encourage you, if you want that, soup to nuts kind of description of rental income properties, go to jwbwebclass.com, sign up for the free investor package. On Thursdays, Gregg and I go over what we like to call the JWB rental income property of the week. Where we break down a property. We go through the part of that investor package is the spreadsheet that you can use to analyze all of your deals that you will get with JWB or anybody else going forward. So I invite you to join us there. If you've already registered for this call, you're going to get reminders about that. It's going to be great. I invite you to join our Facebook group so we can hang out in between. If you want to talk to JWB's team, you want to get those custom answers, go to chatwithjwb.com. It's a really, really good use of your time. I've gone through it recently as I'm investing, and it's really been awesome. And after that, that's it, Gregg. I'm going to kind of give it up to you. Paul, thanks, man. This was incredible, dude. You're the coolest, and I can't wait to be friends with you and kill you in volleyball next time we play. Gregg, I'll leave it up to you, bud.
Oh man, such good times. Hey, Paul, thank you again, brother, for being here. It's been, so many years. Our friendship continues to grow and grow. And I know how special that is, man. It means a lot. Appreciate all you've done for our clients, many of whom we're here on the call here today. And I know that they love having you and your team support them in their growth. So thank you, buddy. Thanks for spending the time with us. Thank you, everybody, for being here on the call. You guys are the reason we have so much fun here. Do want to invite everybody to join us in the watch party tonight. Every Tuesday at 9 p.m., I host the watch party inside of our Facebook group. You can go and check that out at jwbfacebookgroup.com. Go there, join me tonight. I know there's at least 10, 20 of us who jump in who have already seen the show and just want a refresher. And then I'm there for any questions we couldn't answer during our time today. I'll be there answering them live tonight in the watch party on the Facebook group. So thank you, everybody. And we will, let's wish everybody a very happy Thanksgiving. We're not going to see you on Thursday.
Yeah, I missed that. I missed on that one. My bad.
We are not going to see you on Thursday. Little bit of a disappointment there, but I hope everybody has an amazing Thanksgiving. So much to be thankful for. And we will pick it back up next Tuesday at 12:30 on the Not Your Average Investor Show. Take care, everybody.
So let me tease next Tuesday then, right? First of all, super thankful for everybody here. Happy Thanksgiving. Next Tuesday is a client of JWB's, Abraham Guerrero, who is he's actually a pastor, and he uses this stuff to build wealth so that he can, go out and perform his mission of bringing people into his faith and his religion. It's going to be a great story. And he's also got another tool that he's using. I haven't cleared this one with you, Greg, but he wants to talk about it. So we're probably going to talk about it. But yeah, I invite you Tuesdays. I invite you Thursdays. Again, really, really thankful for everybody here. I'm sorry that I messed up on the fact that it was Thanksgiving.
All good, everybody. Thank you all. Have a great night. I'll see you in the watch party. Take care.
See you later. Thanks, Paul.